Welcome to episode 2 of Trade School. In today's video, I want to run you guys through technical analysis, what is liquidity, and introduce you into actually being able to read a chart. So without further ado, I want to run you guys through what I actually use for viewing my charts, and that is TradingView. So if you go to Google, search up TradingView, click on it, go up here to products, first log in. You can log in with Google or create an account. Go to super charts, and then once you click on a blank, it won't look like this. This is my chart with my colors. So to make it look like my charts, right click on the chart, go down to settings, and then on symbol, all my candles that are up are white and all my down candles are black. So for the body, for the border, for the wick of the left side, it's all white. And then my down candle, the opacity is off, and then my borders are just a gray. And then my background is basically just an off black. So it's not exactly black, it's 0A, 0A, 0A. Once you have basically a main chart, it should look pretty clean. But now let's actually get into kind of some introduction into technical analysis. If we want to read a chart, we have to understand how to read an actual candlestick, because you've probably seen a chart before and it's made up of each individual candlestick. So we have the body and then we have the wick. Now, what does this actually represent? For example, if we're looking at a 5-minute chart, that means that each individual candlestick represents 5 minutes. If we're looking at a 15-minute chart, that means each individual candle represents 15 minutes. So that means that within a 15-minute period of time, for example, right? So in this specific case, we'll say a 15-minute. So in a 15-minute period of time, right? Obviously, in the green candle, price went up. In the red candle, price went down. But what does it actually mean? What are the wicks? What are the bodies? So if we look at the body, the bottom of the body is the open. The top is the close. The top of the wick is the high. And the bottom of the wick is the low. For the red candle, it's the same thing, except these are reversed. We opened higher, we went lower, and then we closed lower. And then still same thing, low and high. And at the beginning of this 15-minute period of time, this is basically what is happening. Price opens, market moves lower. That means that this candle at this specific time would be red. But then what ends up happening is we then go back to this price. So now we have the wick showing that price moved down in this 15-minute period of time. So then we go up, we're going up, we're moving higher, and then we end up going all the way to this high and then pulling all the way back. And then at the end of this 15-minute period of cycle, we then leave the wick representing where we ended up going to and where price closed at the end of the 15-minute cycle. So it's the exact same thing for the bearish candle, except it's just flipped. So price opens the 15-minute period of time. We go higher. At this point, it'd be a green candle, right? Because at the start, we opening and we're currently at a higher price. And then we flip bearish. We leave this wick because we ended up going higher. We go lower. And then at the end of this 15-minute period of time, if we go lower and then we pull back, we would leave a wick at the bottom of this candle and it would end up looking like this, right? So this is kind of the first basic introduction into reading a candlestick. And now, again, if it was the same thing on, a 15-minute chart, it would look the exact same thing. And one thing that I want you guys to understand is price is completely fractal, meaning that it doesn't matter what time frame I'm looking at, it'll always be the exact same. So if I'm looking at a 5-minute chart or a 15-minute or a 1 hour or a weekly or a daily, it'll all be made up of these same candles, which means price is fractal. Now, what does fractability mean? Because we trade off of models, which we'll get into in further videos down the line, that means that models can be created on any time frame. So for example, if I draw out a square, now this square I could say is made up of 4 more squares, right? There's, one square here, there's one square here, there's one square here, there's one square in the bottom, right? It's made up of 4 squares, but it's still a square. It's a square inside of a square inside of a square. And I could say in that square, there's also another square right here. So what does fractability mean? When we have a model in the way that price action moves, in the way that candles form, because it's not represented in any different way, it's fractal, meaning that the same models that happen on the bigger time frames also happen on the lower time frames, and they can happen inside of each other, which gives us more clarity as to what is actually happening in price action. So let's look at an actual chart and start to kind of dive in and look at it a bit. So this is the 1 hour chart, meaning each individual candle is a 1 hour time frame. So if we were to zoom in here and kind of look at this kind of choppy price action that's been happening the last 2 days, if we were going to look at this candle right here, well, price moved higher, but at the end of this 1 hour period, we actually flipped all the way back and closed bearish. So we tried to expand, we pulled all the way back, and then what ended up happening afterwards? We then went back lower. So we can read a lot just from the wicks because it's showing us strength and weakness. We can look at just this candle and say, price moved and tried to move all the way back higher, but we pulled all the way back and actually flipped this candle green to red, or to bearish, black in this case. And we ended up, what happened afterwards? Price ended up falling right afterwards, right? And we can see what we're doing right now is now price is showing strength within this candle. Now, how can I understand that price is showing strength? Because of this big, long, bearish wick. We moved all the way lower just for price to get bought all the way back up right now, and we're trying to now expand towards the upside. So there's a lot that we can read just from a single candle on the bigger time frame, and it's the same thing with this bullshit candle right here. What happens? We try to sell all the way back off, but then at the end of this 1 hour cycle, we pull all the way back, price gets bought all the way back up, and what happens right afterward? We then spark a move back towards the upside. Now, I'm currently looking at NASDAQ, and what we'll get into in the next video or in a following video is actually what do I trade? Like, what should you be trading? And you should be trading futures. That's the quick answer to that, but we'll get into in a future video why. Just to base as a little answer to that is tax benefits, more liquidity, easier volatility to trade, and just more cleaner price action. But currently I'm looking at NASDAQ, which is NQ futures, and the only two things that I trade are ES futures and NASDAQ futures. Those are the only two things that I trade. So mess around with the chart. I want you guys to change your charts, get it looking nice, go on TradingView, and just start moving around and looking at candles, how they're forming, how price action's forming. Because basically what price action is, and kind of what I say by when I mean price action, is how bigger structures move. You can see, like, if I was to look at this as just lines instead of looking, too specifically on the candles, I could say, okay, there's a move higher, we moved all the way back lower, and then, we had a big expansion move higher, and then we pulled back, and then maybe we're looking to see another expansion, towards the upside here. Right. Well, how is price action building when it relates to overall strength and weakness, right? Where do we look like we want to go? Because what the biggest foundation of what you're going to be learning is liquidity and how the algorithm moves price. So in the market, there is an algorithm that distributes liquidity throughout the marketplace. And that's the fundamental basis of what our strategy is built off of, is understanding liquidity. Now, we're going to get into liquidity in this video in just a sec. But before I do, I want you to understand and just kind of go on your charts, look at some candles, zoom in at different time frames. You can see if I was to go to a 4 hour time frame and I was just to mark out this candle, I can say that this opened at 10 o'clock. So now if I zoom in, I can see that a lot of stuff happened from 10 o'clock, right? 10 o'clock opened right here. So in that 4 hour candle, there's a lot more information to look at that happened during that 4 hour candle, right? And this is where we can really start to, when we talked about that fractability earlier of the square inside of the square, we can have our model, which we'll get into a little bit later in the videos. But once I can find a bigger time frame model, I can zoom in and look for the exact same thing on the lower time frames because it gives me more precision. And what it is with trading is our goal is to be precise with entries and continue to learn more and grow with what is actually price showing me and how can I react to it in the best way possible. So let's dive into a little bit about what liquidity is and how you can trade it. Now, if we were looking at this blank chart, there's two types of liquidity. There's buy side and sell side liquidity. So buy side liquidity would be the highs. This is where a lot of liquidity is resting. Now, why is a lot of liquidity resting here? Because when the market comes back to an area, there's a lot of orders and limit orders that are resting here within the marketplace. Now, what you have to understand is we have, like, as retail traders, me and you, we don't move the market. We don't have enough capital to actually move the market. So when we look at big institutions and hedge funds that have 90%, 95% of the liquidity that's actually going on throughout the day, what happens is for them to actually fill such massive orders, they have to generate liquidity some way throughout the market. So this would be buy side, this would be sell side. Now, what is this happening? Well, if you're an existing trader, have you ever wondered why sometimes you might put a trade on and then it might go just to stop you out and then it goes right back in your favor? It's because a lot of the time you're putting your stops in areas where a lot of liquidity is resting so that the market will pull back, take that liquidity, generate liquidity to then influx volatility into the marketplace, which is actually the reason why a market is moving. The market will not move if there's not a reason for the market to move in relationship to liquidity. So highs and lows are the biggest representation of what liquidity is. So this would be buy side liquidity, and this would be sell side liquidity if it's at the lows. Now, what does this do? What does this matter? Why do we need this for our trading? Well, because our foundation of what we want to trade is if we know that the market draws towards areas of liquidity, we want to look for manipulation in the opposing direction for price to go lower or higher. So for price to go higher, we must go lower. For price to go lower, we must go higher. And I want to keep this as simple as possible. So if we're looking at this chart, what would I do right now? Right now, I would do nothing because there's buy side resting above and there's sell side resting above. Now, what happens if this happens? Market comes up and we take out buy side. Well, now there's been an influx of liquidity into the marketplace, right? We've taken all of these highs out. So what would I be looking for? Well, market to then fall back into the range and then go to the opposing liquidity pool, right? I would expect once buy sides are taken to now sell off and go take the opposing liquidity pool. So what I'm basically doing and what we want to be waiting for is we want to recognize where are the highest probability areas of liquidity in the marketplace. These are going to be equal highs, bigger highs, lows on the bigger time frame, and we want to wait for them to get taken because if we have a bias that I want to see price go lower, so for example, if we're in a bearish market, I actually want to see us go higher first, take buy side liquidity, and then go sell off to take sell side liquidity later on in the session once it actually has shown me that. And so when we can tie candlesticks to this, so imagine what we're looking at here is a 5-minute chart. And now I go to like a 1 hour. So now we're having a big candle here. We're trying to push up. And then, this candle ends up having a big wick towards the upside and then flips red. So now the candle is showing us the narrative through the liquidity buys, right? So now what would we expect? We expect this candle to most likely flip bearish and have manipulation, and I would want to see us go towards the opposing liquidity pool, which is sell side. So let's look at some real examples, jump into the chart and look at some liquidity. And so you guys know that I'm not just nitpicking random examples. I'm actually just going to replay, go to a random point in the charts. Let's go here, click. And let's do some analysis. So if I'm looking, let's go do a top-down analysis. So what does that mean? I'm basically just going to a bigger time frame, and I'm going to work my way down to the lower time frame. So if I'm looking at this 4 hour, I'm going to say, okay, buy side liquidity is resting at these highs. Sell side liquidity is resting down here at these lows. So now we have a range. This is now considered external liquidity, external liquidity. So any liquidity that is inside of these two, I would consider internal liquidity. So for example, there's a low resting right here. And if I want to see price go towards buy side, I want to see internal liquidity or some sort of liquidity taken for me to get a bigger time frame bias, right? So I would be watching price action. I'd be watching price action. This low never ends up getting taken. So it would be a lower probability for me to take a trade. But we can continue to watch and see what happens. Right now, I would be focused. If we were just to look at the chart, what would I say is the draw on liquidity? Well, how is order flow building? Right now, I can tell we're super bullish. What is the difference of a trend? Well, a bullish trend is if we're making higher highs and higher lows. So for example, we put in a higher high, higher low, higher high, higher low. And that's pretty much what we're doing on this big move towards the upside. So now we're moving towards buy side gets taken. Now, at this point in time, we have to also keep in mind the bigger time frame. There's a reason for price to go higher because we still have external buy side up here on the bigger time frame. So this is an example of buy side and sell side liquidity, but we never ended up taking this sell side. So what I would be wanting to look for is if the price wants to come back down to go take sell side. And there you go. Right after buy side gets taken, what ends up happening? The algorithm has to distribute liquidity throughout the marketplace. So we then fall back into the range to what? Go take the sell side liquidity that we created before going up to take buy side, right? So one thing that I want you guys to understand is there's 4 reasons why markets move. Hunt liquidity, rebalance to inefficiencies, rebalance to equilibrium, and generate liquidity. Now, we're going to go over specifically more in depth on that in the next video. Right now, I want you to basically keep your focus on liquidity. The market moves towards points of liquidity. And you can see just in this example, once buy side gets taken, we then sell off to go take sell side, right? So then what would we expect after this, right? Well, sell side gets taken, we'd probably look to rebalance higher, and that's exactly what happens. Sell side gets taken, we have one last move higher, we then fall back short to then take this recent low, and then once we get displacement, meaning a break to the upside, we then continue and have a move higher here. So let's keep watching price action. Let's go to a new point in time. Select a bar. Let's go over here. Now, when we're at all-time highs, which is this current market that I just clicked on, actually, let me go to a different point because all-time highs is kind of hard. All right. So what's my buy side? What's my sell side? Buy side liquidity, sell side liquidity. I want to see manipulation lower so that price can go higher. Because if I can look at the overall trend, I can say, okay, we're pretty bullish, right? We just had a big move to the upside. So for price to go higher, I want to see price go lower first. So let's watch price action. Now, right now, we're currently looking at the 4 hours. This is the bigger time frame. So boom, sell side gets taken. What am I looking for now? I want to see buy side. Now, this is in a free next video where we'll start to go over specifics of what to look for in the lower time frames. But what would we want to see here? Well, now that price and sell side is taken, there's no reason for price to go lower, right? It is the distribution of liquidity, sell side to buy side, sell side to buy side, to rebalance to inefficiencies, right? So what ends up happening? What do we think can happen after this happens? I want to see us move back to buy side. You can see price is already starting to move. We had an initial rebalance. We're moving higher, and there you go, right? It's the distribution. So for us to go higher, we must go lower first to take sell side. So sell side liquidity, this recent low, and notice that there's no significant low below it. It's just an imbalance, but that's another reason why markets move, to go to imbalances, and we'll go to that in the next video. Sell side gets taken, and then we just go straight to buy side right after. So want to keep this video pretty short and sweet. I want you guys to focus on recognizing liquidity in your charts. Go download TradingView, go use the web application, create your charts, use my color combination. It's super, super clean. I highly recommend you just start using it because I don't like using red and green candlesticks because it inflicts emotion based on the colors. So start drawing buy side and sell side, mess around with the different time frames, and just watch how price reacts to it. My goal with this series is for you guys to build confidence and conviction and make you self-sufficient. The more that you see it happen, the more that you're going to be like, oh my gosh, like this is insane. So the more that you're able to see it, the more that we can then build off of it in the next videos. So your homework is go in your charts, mark sell side, mark buy side, and just watch how the market responds to it. And even when I look at previously what happened here, this high was buy side. We ended up getting taken, sold all the way off to these interlows as well. And what you'll find is the entire market is this relationship of buy side to sell side liquidity. That's basically the wrap up for this second video of Trade School. Hopefully you guys enjoyed. Leave a like, leave a comment, do all that good stuff, and I will see you guys in the next video. Peace out.